You spent 40 years working, 40 years paying into Social Security, and the day you finally start collecting, you assume that money is yours. But here's what nobody tells you. The IRS may be taking a cut of every single check you receive for the rest of your life. And the wildest part? Most retirees have absolutely no idea this is happening. They spent 40 years paying into Social Security. They finally start collecting, and nobody tells them the IRS is waiting on the other side. Today, we're going to fix that. I'm going to show you exactly how the Social Security tax trap works, who gets hit the hardest, the magic number you need to know to protect yourself, and 4 strategies to legally keep more of your money. Let's get into it. Here's the fact that stops most people cold. The IRS can tax up to 85% of your Social Security benefits. Not 10%, not 20%, up to 85%. Now, before you panic, let me explain how this actually works, because it's not as simple as the IRS just taking 85 cents out of every dollar. There's a formula involved, and understanding it is the key to protecting yourself. The formula is built around something called provisional income. And I promise, it sounds more complicated than it is. Provisional income is the IRS's way of measuring your total financial picture in retirement. Here's the formula. Take your adjusted gross income, add any tax-exempt interest you earn, then add 50% of your Social Security benefits. That total is your provisional income. Let me walk through a quick example so this makes sense. Say you have $20,000 in pension income, $2,000 in interest, and you receive $24,000 a year in Social Security benefits. Half of $24,000 is $12,000. Add that to $22,000. Your provisional income is $34,000. Now here's where the thresholds kick in, and this is the number you need to memorize. For single filers, if your provisional income is below $25,000, your Social Security is completely tax-free. 0 taxes, nothing. For married couples filing jointly, that tax-free threshold is $32,000. But once you cross those thresholds, it gets uncomfortable fast. For single filers, between $25,000 and $34,000, up to 50% of your Social Security can become taxable. Cross $34,000, up to 85% of your benefits are now taxable. For married couples, those numbers are $32,000 and $44,000. Now here is the part that should make you genuinely angry. Those thresholds I just mentioned, $25,000, $34,000 for singles, $32,000, $44,000 for couples, they have never been adjusted for inflation. Not once. Not since 1983. Think about what that means. In 1983, those were reasonable thresholds. Today, with Social Security benefits higher and cost of living significantly increased, millions more retirees are getting pushed over those lines every single year, even though their purchasing power hasn't changed at all. More retirees will owe tax on Social Security in 2026 than ever before, simply because Congress refuses to update numbers that are over 40 years old. Let me make this real with actual dollars. The average Social Security benefit right now is about $22,000 a year. If 85% of that becomes taxable, and you're in the 22% tax bracket, you're handing the IRS roughly $4,100 a year. Over a 20-year retirement, that's $82,000, quietly taken from money you already paid into the system your entire working life. And here's a trap that hits married couples especially hard. Most couples assume the tax thresholds for married filing jointly are simply double the single filer thresholds. They're not. A single filer gets a tax-free threshold of $25,000. 2 single filers would get $50,000 combined, but a married couple filing jointly only gets $32,000. That gap catches a lot of couples completely off guard. Add 2 Social Security checks, 2 retirement accounts, and 1 spouse going back to part-time work, and a couple can cross the 85% taxable threshold much faster than either of them expected. This is especially common when required minimum distributions kick in at age 73 and force extra income into the picture, which is a whole other video, by the way, that I'll link at the end. Okay, that was the bad news. Here's the good news. There are real legal strategies to reduce how much of your Social Security gets taxed. And the new 2025 tax law actually added one that most retirees don't know about yet. Strategy 1. Convert traditional IRA money to a Roth IRA before you claim Social Security. Here's why this works. Roth IRA withdrawals are not counted in your provisional income calculation. So, if you can move money from a traditional IRA to a Roth during your lower income years before benefits begin, you shrink your future provisional income and potentially drop below the tax threshold entirely. Yes, you pay taxes now on the conversion, but you avoid years or even decades of Social Security being taxed at 85%. Strategy 2. Time your other income carefully. One-time income events like selling a home, cashing out investments, or taking a large IRA withdrawal can spike your provisional income in a single year, causing more of your Social Security to be taxed that year. Spreading large withdrawals across 2 or 3 tax years instead of taking them all at once can keep you under the threshold and save you thousands.
Strategy 3. If you're 70 and a half or older and you're charitable, use a qualified charitable distribution, or QCD. A QCD lets you donate directly from your IRA to a charity. That money satisfies your required minimum distribution, but never shows up as taxable income. It doesn't count toward provisional income at all, which means it doesn't push more of your Social Security into the taxable zone.
Strategy 4. And this one is brand new. The 2025 tax law added a $6,000 senior deduction for people 65 and older, on top of the regular standard deduction. It's available for tax years 2025 through 2028. If you're 65 or older and your income is below $175,000 as a single filer or $250,000 as a married couple, you qualify. This extra deduction can reduce your taxable income and help keep you under or closer to the provisional income thresholds. Most retirees filing right now have no idea this exists. Make sure you or your accountant claims it. One more practical tip before we wrap up. If you already know your Social Security will be taxed, you can ask the Social Security Administration to withhold federal taxes directly from your monthly benefit. Just fill out Form W-4V and choose 7%, 10%, 12%, or 22% withholding. This prevents a painful surprise tax bill in April and keeps you from getting hit with an underpayment penalty from the IRS. Here's the bottom line. The Social Security tax trap is real, it's growing, and it catches more retirees every single year because Congress hasn't updated those thresholds in over 40 years. But it's not unavoidable. Roth conversions, income timing, QCDs, and the new senior deduction are all tools that can legally put thousands of dollars back in your pocket. If this video helped you, please hit the subscribe button. Every week, I break down exactly these kinds of hidden financial traps so you can stop the system from quietly draining your retirement. I'll link a free provisional income calculator in the description so you can run your own numbers today. Takes about 2 minutes and could save you thousands. Thanks for watching. I'll see you in the next one.